Hey, what's up guys? In this video, I'm going to analyze the stock of Deere Company. I'm going to look at their financial statements, look at their balance sheet, their profitability, and ultimately use an intrinsic valuation model and try and figure out what they're worth and if they're a good buy right now. So if you're new to the channel, my name is Dan. I'm a business school professor interested in accounting and finance. So if you're into that kind of thing, hit that subscribe button to check out more videos like this one. Alright, let's jump into it. So this is John Deere Company. If you don't know about them now, you know. You've probably seen their products all over the place. They are an equipment manufacturer. They operate in 3 segments. Here are the revenues and operating income for each of those segments. Keep in mind that all numbers are in millions of US dollars. So their main segment is what you saw on the previous page there, agricultural and turf, responsible for the bulk of their revenues there. This is the equipment you normally see. You might have a neighbor that mows their lawn with this kind of thing. They also have a construction and forestry segment, accounting for about $8.9 billion of revenue, and they have a financial services segment. So they make money on financing the purchase of these things. Now, as far as where the revenue comes from, 60% is from the US and Canada combined, and 40% is a combination of other countries. So here are some stats for Deere Company's balance sheet. Right away, I noticed a pretty high liabilities-to-assets ratio. Not out of control, but a little on the high side there, above 80%. So they are a little bit more highly levered. Not a lot of that is debt, as you can see with the low debt to assets ratio, but it is other forms of long-term liabilities, things like leases, pension obligations, things like that. So, to me, it's kind of the same idea there. They have fairly high leverage. Now, as far as short-term liquidity concerns, I have none for this company. Current ratio 2.3, very healthy. By the way, if you don't know any of these ratios, check them out in the description below. Quick ratio above 2, very healthy. I always want to see current ratio and quick ratio above 1, so to have them above 2 is the extra cushion there. Interest coverage ratio is not anywhere near the danger zone there, close to 15. What I find interesting is that not a lot of their assets are long-term. And for a manufacturing company like Deere Company, I had thought that they would have more long-term assets. That is not the case, so that's nice to see. Alright, so here's a DuPont analysis for Deere Company. I'm just going to take the return on equity and break it down into 3 parts there and see how they construct their return on equity. So what I can see here right away is a pretty good return on equity, ranging from 22% all the way to 33% in 1 year, but overall pretty consistent. It's made up of 3 parts. The first part is net income margin, which is how much profit you generate for every dollar of sales. So for this company, the answer to that in the most recent period is about 7.7 cents for every dollar of sales. Now that's not high, but that is okay for their industry. The asset turnover is, a little bit lower than I'd like to see. Asset turnover tells you for every dollar of assets in place, how much sales can we generate. And for this company, it looks to be around 50 cents, for every dollar of assets. So that's not so efficient, but it's not horrible. The equity multiplier is pretty darn high, and that is really what is driving these higher return on equity numbers. So, if you think of return on assets being net income margin times asset turnover, if you think of that as being the pure profitability of a company before considering leverage, that's actually pretty low for Deere Company. What really helps them is borrowing money here. So again, not a great picture of profitability. Here is some dividend data for Deere Company. They are a pretty regular dividend payer. The yield is less than 1%, so that's really not great. But they have a 5-year growth rate of 4.84%. Yeah, still not very good there, guys. The payout ratio is only 23%, so they are holding back quite a bit there, reinvesting back into the company or maybe buying their shares back. Let's have a look at buybacks. Alright guys, so as I suspected, they are holding back on those dividend payments. They really have a lot more to give, and they're actually giving it in the form of share buybacks. So in red here, you got share buybacks. In blue, you got dividends. And they're spending at least twice as much on share buybacks as they do on dividends every year for the past 5 years. So for example, to give you a magnitude of this, in the past year, they spent about $2.5 billion on share buybacks. Now this company currently has a market cap of about $100 billion. So they bought back essentially 2.5% of their shares outstanding in the past year. A move like that is definitely going to lead to some share price appreciation. Here are the payout ratios for this company for the past 5 years. Again, in blue there, you got the regular payout ratio. And what I see there is that, yes, they're kind of holding back. They really could pay a higher dividend. But in green is what's more interesting here. Green is the modified payout ratio there. I don't like to see that. I love the buybacks, but what I see here is that those buybacks cannot continue at the pace they've been going at. They're definitely going to be slowing down. In the long run, you can't spend more than what you earn. The next thing I want to do is use an intrinsic valuation model to model Deere. But really, to make that work, I need to have a sense of how much they're going to grow. And so what I can see here from this graph here is revenue in millions of dollars over time. When I look at it as a whole, I don't really see a lot of growth. You can see in 2011, they generated about $32 billion of revenue. In the past year, they was about $35 billion. That's pretty pathetic growth. Now, despite the picture of really flat growth going on right now, we have analysts currently forecasting pretty incredible earnings growth for October 2021 here. They expect earnings per share to grow by about 50%, getting all the way to $13 per share. They then expect earnings to grow another 18.86% after that, and then about 15% in the year following. So I'm going to use these estimates to get kind of an average growth rate over the next 5 years for Deere Company. Okay guys, so at this point in the video, I want to come up with a fair value for Deere Company. To do that, I'm going to use an intrinsic valuation model, specifically the free cash flow to equity model. Now, to make the model work, I need estimates of what free cash flows to equity are going to be. To do that, I'm going to estimate next year's free cash flow to equity and then go from there using analyst forecasts that we just looked at. Using that forecast data, I'll come up with an average growth rate over the next 5 years. I also need a discount rate to discount those cash flows back to present value. Given Deere's balance sheet, I think a bit of a higher discount rate is in order. Now, they have a very solid business. They're a household name. I don't think we need to be getting to 9 or 10% discount rates here, but the discount rate should be a bit higher. Anyhow, I'm going to show you guys what the value would be under a variety of discount rates and a variety of assumptions about growth and free cash flows, and you can decide for yourself. So let's have a look. So what we're looking at here is a valuation matrix where each value in the cell here is equal to the fair value of Deere Company for a given discount rate and also a given growth rate in the free cash flow to equity over the next 5 years. After 5 years, we're just assuming about a 2% growth rate forever. So what I see here is a variety of values. Which is the most relevant value? Well, again, for me, I see them as a little riskier with that debt. So I'm looking more at this row right here, about 8% discount rate. 9% if you want to be conservative. And so as far as the growth rate for the next 5 years, we saw analysts forecast. I went ahead and did a 50% growth rate for next year as they're forecasting. And after that, we only have the next 2 years. Looks like about 18, about 15% or so. So I'm looking at, about the next 4 years after the first one. It's hard to say. I put up the most optimistic case being 18%, but I also put, the most pessimistic here. Let's say it averages out to be about 9%. Which value is most likely? I'm a little more conservative. I might be hanging out in this cell right here, about 8% discount rate, 12% growth rate average the next 5 years. And that would make it not a very good deal right now. Now, another way of looking at this whole thing is to say, look, I require a certain rate of return. Say, hey, I want 8%. No, I want a 9% return on my investment. I think they're going to grow at 15% per year. So I can't pay any more than $244.60 per share. That's another way of interpreting it. Here in the matrix below, it kind of visualizes it for you, whether it's overvalued in red there or undervalued in green relative to the share price today of about $313. So as you can see here, it's really only a good deal if you assume a lower discount rate. Insider trading for Deere Company, not a lot to see here. Pretty equal number of buys and sells by the insiders. When you look at the actual number of shares involved, you actually see a little bit more selling than buying activity in the past 12-month period and the last 3-month period. So on the whole, slightly negative. Alright guys, so here are my final thoughts on Deere Company. First of all, hit that like button, always helps, really appreciate it. Secondly, I'm not very impressed with their balance sheet. They've really borrowed a lot of money to buy shares back. And while that may have helped their stock return for the past few years, that probably really did help those who got in, 2 or 3 years ago. It's not really helping the current situation for people that want to buy into the stock right now. So for me, that's a turnoff. The profitability is not that impressive. I think their return on equity is largely driven by leverage and buybacks. And I'm really not sure, again, if they can continue the buybacks to the level they have been. So I'm really not thrilled with the company as a whole. And when we look at the valuation, it's pretty clear here that it's not a buy for most people. It could be a buy for some of us. If you want a company like that in your portfolio, you're willing to accept maybe a mediocre return in exchange for, a big blue chip stock, a little bit safer, a little bit more of a moat in their business. I could see owning it for those reasons. Me personally, I'm not going to buy any. But, let me know what you're going to do in the comments below. Those are just my opinion. Thank you guys for watching.